And then yesterday we were saying that in case the market rises as expected, the premiums would shoot up for the calls. Did that really happen? Let's see. It was all red, remember? Now it is all green. Can you see here the change in the price? So we had taken a reference of 18,300 call. It rose by 126 points. Remember how much it was? 167 minus 126. It was 41. 41 rupees has now become 167. It means that you have multiplied your money by 4 times in just one day. This is the power of options. And unfortunately, those who thought that it would fall, they have lost heavily. Do not get overwhelmed thinking that sir, options is the real way to make income. In a day we are able to make 2 times, 3 times, 4 times. Our risk is only 1 rupee, but reward can be 1, 2, 3, 4, 5, 10, 20, 100. Risk is limited, reward is unlimited. But I also told you, this happens once in a while. Generally, this kind of big movement in a single day is very rare. Rarely you get to see that. That is why do not ever come to a conclusion now itself stating that the real way to make income is options. No, totally no. Neither buying options is good nor selling options is good. Combination of buying and selling is definitely good. Futures, just leave it. Futures is only for knowledge. We will only work in options. Alright. Another advantage for a buyer of an option is you do not require the margin as big as futures. The lot size of Nifty is 50 into the premium. Let's say that I am buying a call of 18,600 at 28. So 28 rupees into 50. Just 1400 rupees should be there in my account, then I can buy this option. Because that is what is a maximum risk. Even if market goes to zero, I will lose only 1400. I am expecting by Friday, all this will become zero. I am expecting by Friday, all this will become zero. What do I mean? I do not see market crossing this threshold. I do not see market rising beyond this point. So remember, if the ball doesn't touch any particular flag, it is all zero value. Remember the break even point. What is the break even point? 18,600 plus premium. So those whoever is buying 18,600 strike, he will have to wait till 18,628. Beyond that only the profits would start. Below that it will be a loss of 28 rupees. So likely that all this is going to become zero. We are going to monitor this on Thursday, because Thursday is the expiry day. Now you have bought this contract for Thursday, that is 17th November. But I told you need not hold till the last date. You bought it on Thursday, and you have sold it tomorrow. You are already out of the contract. You can buy in the morning and sell in the evening also. This is the maximum time, not a compulsion time. Alright. So whether it is futures or options, you can square off your position even before the expiry, maximum by expiry. Let us work one more example of buying of a call. I want you to work out with this. Nifty 18,500 call buy at. We'll take round figure 60 rupees. I'll give you 2 minutes of time to work, then I'll tell you what are the results. So Nifty may expire at 17,000, maybe 18,000, maybe 18,550 or 18,500 will take it. 18,550, 18,560. This is your break-even point. Always first calculate the break-even point, then things will become simple for you. So quickly, 1 minute of time, compute it. Alright, so let us compute it. Always first calculate the break-even point in any options that we are dealing, whether it is combination of option or standalone option, whether it is buying a call or buying a put, whether it is selling a call or selling a put. See, these are only the 4 weapons we have: buy call, buy put, sell put. With these 4 weapons, we are going to create various strategies. But the thumb rule says that first calculate the break even point, then the calculation would become very easy. Now one thing I know, that if the price is rising, I'll be making money. The next thing that you'll have to do is find out the direction of profit and loss. First break even point, then the direction of profit and loss. So these are all going to be minus, 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 minus. This is all going to be plus, plus, plus. So 18,600 minus 18,560, I would be making a profit of 40 points. Here I'll be making a profit of 240 points. Here 440 points. Into lot size if you do, that is the exact value of profit. But in case the price falls, 18,550 minus 18,560, I would lose 10 rupees. Here how much I would lose? 60 rupees. Here how much I would lose? 160. But can I write here 160? No. Because why? Something you bought at 60 may become 0, it cannot go negative. That is why our reverse loss is always 60, no matter what. So kindly tally, hope you have got the same values. In case you haven't, please rectify it. These are the right values. And now I'm going to give you a table which will help you to simplify options. So need not write all that. I'm anyway going to give you the notes. But this table you have to definitely draw right now. This table is the entire option game for whether it is future, whether it is option trading in India or in international market. It is forex, it is commodity, it is cryptocurrency. Same formula, same terminology everywhere. Please draw this table, and if possible take a screenshot also. I'll anyway provide you this file also. right? So hope you have drawn it. In case you haven't, take a screenshot, and then when you are free you can draw it. And now the thumb rule. So I'll give you another few seconds of time. Take a screenshot in case you haven't. Okay, now the thumb rule. Any option that you are dealing, always follow this thumb rule only. Write it down. Okay, so the thumb rule says that firstly calculate the break-even point while dealing with any of the options or option combination of any instrument. Then make a note of the strike price and arrive at the break-even point using this rule. So what's the break-even point formula? Strike price plus premium when it is called. Shortly we will see the puts also. So strike price minus premium is for the puts. Alright. And then to calculate the profit or loss, very simple. Share price minus break even point for the call. Break even point minus share price for the put. That is on the buy side. But when we talk about the sell put, then also it is share price minus break even point. So this is where little confusion may come. So be very, very careful about this. Bullish view means what? Yesterday I've already told you. Either we buy call or we sell put. In both the cases, your profit loss report would be share price minus break even point. Alright. And for bearish view, if you feel that the price may fall down, wherein you can either buy put or sell call, the formula for profit loss would be break even point minus share price. So this is all what you will have to know while dealing with options. Lastly, while selling options, maximum profit is premium, and while buying options, maximum loss is premium. See, buyers and sellers are totally opposite. If for a buyer the loss is limited, for seller the profit is limited. If for the buyer the profits can be unlimited, for the seller the losses can be unlimited. So we are going to work out with the selling of options now. Margin required for seller of options is futures lot margin, while for buyer maximum risk is equals to margin, that is lot size into premium. That's what I told you a while back, that the premium at 18,500 call expiry is only 28 rupees. 18,600, sorry, is only 28 rupees. So 28 rupees into lot size 50 is equals to 14,000. With 14,000 rupees also you will be able to buy one lot of 18,600 call expiry. You don't require any extra margin because that is what is your worst loss. But in order to sell an option, you require the margin of futures. Every broker will provide you that margin sheet. This is same with every broker. This is released by SEBI and it changes every day. The margin changes every day depending upon the volatility of the stock. If the stock is highly volatile, the margin will be high. The stock is stable, the margin will be low. So go into the broker's terminal and somewhere in the menu you will be able to find the list of the companies for F&O as well as the margin required for that particular day. But for buyer of an option, always same rule. Lot size into the premium. That is what the margin would be required. Only for seller, the margin is dynamic. Let us now deal with selling of options. So this we have discussed about the buying. And now coming to contract 2, that is sell, call. Here, rather, in this case, the profit loss report is exactly to buy exactly opposite. So let me copy this. So plus becomes minus, minus becomes plus. Break even point remains same. View changes. For a buyer, if he is making money in rising price, seller will make money in the falling price. Quickly note down. along with the example here. Okay, cell call, write it down. This is 18,500. Yeah. Alright, so hope you have done this. So nothing but exactly opposite to buy call. Now you may say, who the foolish would be to sell a call? I am one of them. The real game in options is in selling, not in buying. You may think that, sir, there is a scope for unlimited loss. Why the hell are you playing with selling of options? Agree, the loss is unlimited. But do you think I will wait for these prices to go till here? Why not I exit here itself? Why not I exit at a minor loss? Why would I even allow my account to blown up? I told you don't have to wait till 17th November. You see that you have started making loss, the loss are increasing, increasing, increasing. Exit. Till it reaches your neck, exit. Do not wait for a loss which you cannot digest. But advantage would be that 80% probability that the price will go here, because if you see the price right now for Nifty is 18,350, right? And we have got only 4 working days: Monday, Tuesday, Wednesday, Thursday. In 4 working days, if Nifty falls, I will make money. If Nifty remains wherever it is, I will make money. If Nifty rises slightly, I will still make money. If Nifty rises massively, I will lose little bit. But if it rises extraordinary, which is very rare, then I would lose heavily. But question is, before this extraordinary rise, it has to pass through this, right? You set a Lakshman Rekha for yourself. If Nifty reaches this point, I will exit. If your risk appetite is more, maybe at 18,700, where you will be able to make a loss of minus 140, at least exit here. Out of 10 trades, 7 trades you don't have to worry about this, because it's a very rare phenomenon that such a massive rise will come. But in that 3 trades will be there where it will give you a pain. I'd say that with less pain, get out. Some other trade we will cover this loss. But for now, get out. That's the only formula. Do not wait. Hope it is clear. Now we will be dealing with put. Buy, put. So buy call, sell call, both are clear. Now buy put. What is the formula for break-even point? I told you always first, break-even point is equals to strike price minus premium. Strike price minus premium is the break-even point for buying of a put. For buy of a call it is plus, but for put it is minus. And then profit will be one side. Once the break-even point is done, you know that profit would be in falling prices and losses in rising prices. However, loss is limited to premium while no limit on profits. More the fall, higher is the profit. So here it is reverse. You will make more money as the price falls more and more. Now an example. Nifty right now is trading at 18,300. So let us take 18,000 put expiry, buy at so right side is all puts. This is all puts, this is all calls. 18,000 put is available at just 17 rupees. Okay. Now you are going to calculate what would be the profit loss at these points. 12,000 or say 10,000, 15,000. then 17,500, 17,800. These are practical values. This is very rare phenomenon. Small falls may come even on the slightest bad news, but big falls will come only on severe bad news. But stock market, anything can happen at any point of time. There are thousand reasons for the markets to fall, guys. There may be war, there may be earthquake, there may be natural calamity, there may be some astronaut attack, there may be asteroid attack. Then there could be some kind of company coming out with a big fraud. So there may be hundreds and thousands of reasons for the markets to fall. But for the market to rise, there should be only one reason. Nothing happens to the world. No pandemic, no earthquake, no tsunami, no big prime minister dies. Nothing happens. Everything goes on stable. No big company goes into fraud. So that is why markets don't rise by leaps and bounds. They rise slowly, 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 because that fear will always be there among the investors that anything bad may happen anytime. One we have already experienced 2 years back, that is a COVID. So like that, there will be some or other excuses will keep coming in the future. Either it will be war, or it will be pandemic, or it will be some kind of natural calamity or some terrorist attack. When the terrorists attacked the Twin Towers in America, markets fell heavily globally. When first time Russia attacked Ukraine, market fell heavily globally. So these events are global, which affects every country. So that is why one advantage what a put buyer will have, and an advantage what a call seller will have. To say ground is limited, that means for a buyer of an option, worst case is that he will fall to ground, he cannot go underground. But if he flies, he can fly till sky. That's the advantage for a buyer of an option. But it's a very rare phenomenon that such a big event would happen. It happens, but very rare. We never know when it would happen. So should we buy options or should we sell options? Again, I tell the same point. Neither buying options is good, nor selling options is good. Combination is good. Combination with adjustment, which will be clear when we come into multi-leg options. What will happen at 17,983? What is so special about this figure? It is the break-even point. What is the break-even point formula? Strike price minus premium. Strike price is 18,000 minus 17 rupees is 983. So 17,983 is 0. And this one we know that this is all going to be profit. Here it will be all going to loss. You are going to calculate the profit and loss and show it to me. I'll give you 2 minutes of time for this. So 2 minutes of time, quickly compute the profit loss. This is a subject where only practice will give you perfection. This is not theoretical, this is maths. So if I am showing you 2 examples, at home you have to work with 20 examples. Not just Nifty, do on Bank Nifty, do on Reliance, do on Infosys, do on TCS, SBI. Whatever your favorite companies are there, do it there. Okay, so let's do it. So what is the formula for profit loss? See, one thing, always first give the plus and minus. By this way, the calculation would become easy for you. We are going to make money in the falling prices. Alright. Now, how much of loss we would make as a buyer of an option? Always the loss is going to be limited, subject to premium. This is what I'll be making worst case. So I do not have to worry even if the some severe good news comes and the market explodes. See, why I'll tell you that seller of an call is good. I told you na that mostly I sell call. Because market will rise sharply only in case there is some severe good news. Now, what can be that severe good news? It could be that India digs underground and finds out some treasure. Okay, India finds out some treasure, some huge gold may come. Or apart from that, I don't find any other good news. So the sudden good news is cannot be as a surprise. Never that we have experienced that in our lifelong till date. That is sudden good news for the economy has come. No. So because this event is very rare, it doesn't happen. That is why most of the time the seller of a call makes profit. Don't sell very near, sell it little far away and adjust it. Don't wait for the loss to get big. Exit early. Alright. And what would be the profit in case the price falls down? So what you'll have to do, this one minus this one, this one minus this one, this one minus this one, other way around. What we did for the call, this one minus this one minus this one minus this. But here, this is the first number for reference, this is the second number which has to be subtracted. So profit of 183 points, here the profit of 483, here the profit of 2983 and here 7983. This is how the profit loss would be. Alright. Kindly tally the values in case you haven't got that. So with this strategy, a sudden bad news comes, you would have made a jackpot where the entire public would be crying, "Arey pandemic, we have lost money hugely." And you will be rejoicing because you would have multiplied your money by several hundreds of times. So those who ever did this during the COVID time, we were trading at nearly 12,000 and post COVID we went down till 7,000. So those who ever, these options were available at 10, 11, 12 rupees, the deep money options. So that 10, 11 rupees had become thousands of rupees. How much deep you go, that much cheap options will be finding. If 18,000 is 17 rupees, 17,000 is peanuts, just 2 rupees. Let's say in the next 4 days any bad event happens and the market crashes badly, these 2 rupees may be even become 2,000. If you ask me how many times it has happened in the last 30 years of our history of market, it has happened nearly 10 times. Not 10 times, 20 times. It has happened approximately 20 times that within a matter of 3-4 days, markets have fallen down by more than 2,000 points. More than 2,000 points. So on an average, it comes once in a year. But that's why so much of patience would be required. That means you'll be taking 50 trades like this, and all the time you'll be making loss, loss, loss. Why loss? Because your market is at 18,300. Even if it is falling down, you won't make money. It has to fall severely, then only you'll make money. So the chances of that is like a lottery ticket, 1-2% only. Out of 100 trades you take, then maybe one jackpot you will be able to crack. So that kind of patience you require. We don't have so much of patience, so better not to do it blindly. I told you combination has to be done. So this is for the buying option. Exactly opposite is for the selling of option. Now we have all these four weapons in our hand. So write down an example even for selling of option, selling put. The break-even point remains same, but profit would be in rising prices and losses would be in falling price. Profit is limited to premium while no limit on loss. Plus becomes minus, minus becomes plus. So from whomever that you have bought the option, his money, his loss is only your gain. Write it up. All right. So this is what is your buying and selling of options. Buy put, sell put, buy call, sell call. Hope everything is clear till now. Monday's class we are going to discuss about taking combination of options. So there you'll realize that neither buying of options is good nor selling of options is good, but when you're combining it appropriately, then when you lose 1 rupee, but when you gain, you'll be gaining 2 rupees. Right? So this is what we are going to see in the coming classes. Any doubts or questions, you can use the audio control or the chat window.